Hi forex traders, so welcome back. My name is Francis from Caris Trading Institute. If you are a returning viewer, you're welcome. But if you are a new viewer on this channel, I would like you to quickly click the subscription button and don't forget to click the notification bell so you stay updated every time I post a video. In today's episode, I want to show you one of the risk management strategies to scale up prop firm evaluations without blowing your account all the times or without breaching the rules of prop firm evaluations. There are a lot of traders struggling with how to meet up the 10%, 8% target of a proprietary firm without breaching the 5% or 6% daily drawdowns and the maximum 10 or 12 maximum drawdowns. Okay, I'm going to show you how to stay long in the game. Okay, although it depends on your risk appetite, but whatever it is, I want to show you how to appropriately use the right risk management approach so that you can stay longer in the game and cash out consistently on proprietary firms across. So I'm going to show you how to know what lot size to pick or what lot size to use on the accounts that you are trading. So for example, let's say you are trading a $100,000 evaluation account. Okay, remember the rules are you must not lose 5% of the account daily or 6% of that account every day. That means you are not supposed to lose $6,000 or $5,000 every day. The first question is, how do I know what lot size I'm supposed to use? By now, I know you should have been done with finding an edge. We actually have a workable system. That's why you want to try proprietary evaluation, because if you don't have a system that works, there is no point trying to do a prop firm evaluation. You can just start up with the free challenge and then test your system using that. But once your system is workable, you have a proven system that works, then this is the right risk management approach to use. Okay, this is what I've been able to do to get funded across 3 proprietary firms. This is what I've been able to do to get funded with 3 proprietary firms. Okay, so the first is I want to know what account size you are trading. So we are trading, for example, a $100,000 account. Then $100,000 account, multiply it by the risks you want to take. What's your risk appetite? The appropriate risk to take is 1%. Never go above 1% of your account. I'm saying this again, never go against 1% of your account if you really want to stay long in the game, except you want to just blow the account and they take up the account because you have breached the rule. Okay, so when you do $100,000 times 1%, then you divide it by your stop loss. That's the number of pips you are willing to risk per trade you take. So for example, because of the system I use, is a precision entry concept, my stop losses should never go above 20%. So I'm using a 20% stop loss. So when you do $100,000 times 1%, that's $1,000. Then divide it by 20, that is actually 50. It's going to give you 50. It equals to 50. Then divide this 50 by divided by 10, because that 50 is 50 mini lots. Divided by 10 is going to give you standard lots. Then 50 divided by 10 is going to give you 5. It's equals to 5. So that is your standard lot. I really hope that this strategy is as easy as it is. On a $100,000 account, multiply by 1%, that's the risks you are taking on the account per trade you take. You are not willing to risk 1% for every trade you take. And then divide that by the amount of pips you are willing to lose in terms of stop loss. So your stop loss is 20 pips, for example, and then this gives you the result, right? But in mini lots, then you divide it by 10 to get the standard lot. So on $100,000, the maximum lots I should use is 5 lot size. That's the maximum standard lot I should use on a $100,000 account. For every trade I take, this can be spread across. You can just do 5 standard lots at once. Okay, so what is the logic behind this? If you lose 2 times or 3 times, you only lose 3% of your account. But remember, your daily drawdown is actually what? Your daily drawdown is 5%. Okay, now the discipline to stay with this is actually the problem for most traders. Most traders cannot sustain the discipline to adhere to these rules because they are seeing a trade that looks like a high probability trade, and then you want to finish your challenge overnight or in one day so that you can do a video and tell us, oh, I finished a Prof challenge in 24 hours. Guys, you are not here to prove a point to anybody. You are here to make money, and if you want to make money, the surest way to do this is to incorporate a standard risk management approach in your system. That's the only way to play the long-term game and cash out consistently. So once you do this, you know your standard lot. Even if you lose 3 times, that means you only lose 3% of the account. Then you go to sleep. I don't know what your trading model is, but in my trading model, I'm not supposed to take more than 3 trades a day. Okay, so once, I lose twice, I lose the 3rd time, I just close it and I go to sleep. The next day I come back. What is now your risk reward ratio? Your risk reward ratio should be minimum of 1:3. 1:3. 1:3. That's your minimum risk reward ratio. 1:3. So that means when you lose, you are only losing 1% of your account. When you win, you are winning 3% of your account. So if you lose, you are losing $1,000. If you win, you are gaining $3,000. So guys, think about this. If you lose 3 times, you only lost $3,000. If you win 3 times, you will win $9,000. So literally, if you have 4 winning streaks at once without a loss, that means you are done with the challenge. If you have 4 winning streaks and 1 losing streak, you will still be done with your challenge. If you have 4 winning streak and only 2 losing streak, you will still be done with the first stage of the evaluation, guys. Okay guys, so I think this is what I've been able to do, and this has worked consistently for me. So guys, another way to do this is to just go to babypips.com and then look for position size calculator. Then it's going to help you do this automatically. So what you have here is choose the currency you are trading. If it's dollars, choose dollars, then put the equity, which is $100,000 for example. Then on the $100,000, what's the percent you are willing to risk? The percent we are willing to risk is 1%, and then stop loss is 20 pips, and then let's say 20 pips stop loss. The currency pair is GBP USD, the one I trade. So literally, you see what this is telling you, right? On babypips.com, for every 1% you miss, okay, I think I need to calculate this, sorry. So you see this, when you click on calculate, it's already going to give you what you are risking for every trade. You are risking $1,000, which is 1% of the account. And then if you do 1:3 standard risk reward ratio, for every 3 trades you lose, you only lose $3,000. For every 1 trade you lose $1,000. If you win 3, you will win $9,000. So the position size is 500,000 units, standard lot is 5, mini lot is 50, micro lot 500, and then this is what you are supposed to stick with. Guys, this is the only way to make it trading proprietary firm evaluations. I hope you enjoy my video. Don't forget to like, share, and subscribe to this channel. Until next time, I wish you good luck with trading.